costs and taxes turn a winner's game into a loser's game. The Little Book of Common Sense Investing Part 3. An investor was sitting in the night with his laptop open. The statement showed a profit, but something felt strange inside. The market had performed well, yet his final return was significantly lower than expected. He thought, did I choose the wrong company? Then he looked at the fees, looked at the taxes, and looked at the transactions. That is when he understood, losses do not always happen because the market falls. Many times the market is winning, companies are earning profits, the economy is moving forward, but the full benefit does not reach the investor's pocket. John Bogle explains this very hidden pain. He says that while the stock market can be a winner's game in the long term, investors turn it into a loser's game themselves. In Part 2, we saw the story of the 𝐼𝐸 family. The entire family owned America's companies, so the benefit of corporate growth directly reached the whole family. Then the experts arrived. They said, buy and sell shares among yourselves, pick winners and earn extra returns. It sounded smart, but the real game was hidden in the fees. The shares were just moving around within the family. The total ownership remained the same, the total market remained the same, but advisors, managers and brokers started cutting their share in the middle. The 𝐼𝐸 family mistook more activity for more progress. Meetings increased, reports increased, trading increased, but the net return started falling. This is the biggest irony of investing. The lesson from Part 2 was clear. The market itself often does not cause the most damage. The damage is done by unnecessary costs, restless behavior, and the habit of repeatedly changing decisions. Now in Part 3, Bogle explains that pain in the language of numbers. And this is where the story gets scary, because small fees do not remain small over a long period. Imagine the entire market is a large field. This field produces a harvest every year. If the owner keeps the harvest themselves, their benefit is substantial. But if at every turn someone cuts away labor costs, brokerage, management fees and commissions, the field remains the same, the harvest remains the same, but less grain reaches the owner's house. Bogle says that all investors combined make up the market. This means that before costs, the total return of all investors will be exactly what the market has delivered. If the market has earned an average of 8%, then all investors combined will share roughly that same return before costs. But after costs, the story changes. Investors who paid lower fees kept a larger share of the market return. Investors who paid higher fees automatically saw their share become smaller. There is no magic here, just simple arithmetic. If the market return is 8 and your total cost is 2.5, you are left with roughly 5.5. 2.5% sounds small. People think, what difference will such a small fee make? But in compounding, even small things turn into mountains after years. Suppose an investor invests 1 lakh rupees for the long term. If they get an 8% annual return, the amount can become very large after 50 years. But if the return drops to 5.5% after costs are deducted, the final amount is dramatically reduced. This is Bogle's most painful lesson. If 1 lakh rupees grows at 8% for 50 years, the value can reach approximately 47 lakh rupees. The same money at 5.5% might stay around 15 lakh rupees. This is not an exact promise, just an illustration. But the lesson from this is clear. A small difference in return can create a massive difference in wealth over time. Bogle calls this difference the compounding cost. Just as returns compound, the loss from costs also compounds. An investor needs to understand both directions. If you get a slightly lower return every year, you do not just lose the money for that year. You also lose the future returns on that lost return. This is why costs look small, but the impact is huge. Fees leave your account quietly, so their future impact is not immediately visible in the statement. In an active fund, the manager does research, picks stocks, and tries to beat the market. This is hard work, which is why it comes with a cost. The problem starts when the cost is guaranteed, but the extra return is not. Fees are deducted every year, whether the fund beats the market or not. The promise of an index fund is different. It says, I will not run the costly race to beat the market. I will follow the market at a low cost. This simplicity is the strength of an index fund. It involves no dramatic predictions, no fancy trading, and no pressure to make a new decision every day. But fund fees are not the only cost. Bogle says that taxes are also a cost. And taxes often quietly slow down an investor's compounding. There is an old saying in the stock market, the more the motion, the less the return. Meaning the more the buying and selling, the higher the costs and often the tax impact. In active funds, shares can be bought and sold frequently. If the manager feels another company will do better, they sell the old shares and buy new ones. Sometimes this decision can be right, sometimes wrong, but every transaction brings friction. Small expenses like brokerage, bid-ask spread, market impact and taxes keep adding up. Tax rules are different in every country. In India too, equity fund taxation, holding periods and capital gains rules can change over time, so an investor must understand the current rules. But the principle remains stable. If you book profits quickly, taxes can be triggered early. Because of this, the money does not stay invested long enough for compounding. An index fund generally maintains a low turnover because it follows its index. Unless there is a change in the index, there is no need for excessive buying and selling. Low turnover means tax efficiency can be better. This is not a guarantee in every case, but it is considered a major practical advantage of long-term index investing. Bogle showed in his historical examples that there can be a wide gap between the gross returns of actively managed funds and the after-cost returns received by investors. His message was not that every active fund is bad. The message was that the average investor should not take fees, taxes and trading drag lightly. If an active fund earned 10%, but less was left in the investor's hands after cost and tax drag, the headline return can be misleading. On the other hand, the gross return of an index fund might be just like the market, but due to low costs and lower turnover, the net return can be more competitive. This is why Bogle repeatedly focuses on the net return. An investor does not buy groceries at the gross price, they pay the final bill. In investing too, the final bill is what matters. The performance in a mutual fund brochure can look spectacular. But the investor should ask, how much after fees? How much after taxes? How much after inflation? Inflation is also a silent cost. If your money is growing but prices are also rising, the real purchasing power tells a different story. Bogle's common sense investing does not teach us to chase the highest return. It teaches us to keep a larger share of our return. This difference is huge. One investor searches for a jackpot. The other plugs the leakage. In the long term, the investor who plugs the leakage can build more stable wealth. The story of the 𝐼𝐸 family comes to mind again here. They tried to buy more intelligence, but the people in the middle ate up a large share of the family's return. Today's investor can make the same mistake. Every year they follow a new star fund, a new strategy video, a new hot sector and a new expert. But every shift has a cost. Sometimes an exit load, sometimes tax, sometimes wrong timing, sometimes an emotional mistake. From the outside you see action, from the inside compounding breaks. An index fund investor's job can look boring. They do not trade much, do not look for daily excitement, and do not change their portfolio at every market noise. Yet this boring behavior is often powerful. Because money does not need attention to grow, it needs time. Tampering with it every day can disturb compounding. For a common person, this lesson is highly practical. Salary comes in, expenses go out, goals are big. In such a situation, the investment system must be simple. If the system is so complicated that it causes fear every month, the investor will not be able to stick around for the long term. And in investing, sticking around is half the victory. Bogle says, do not turn market ownership into a casino. Stocks are not just moving numbers on a screen. Behind them are real businesses, real profits, real workers. When you own a broad index, you become a partner in a large part of the economy. Your entire hope does not rest on a single prediction. But even when choosing an index fund, one should not close their eyes. It is important to understand the expense ratio, tracking error, fund size, index quality, and your own risk capacity. Low cost does not mean zero risk. The market can fall, returns can be negative, and patience can be tested multiple times in the long-term journey. Therefore, an equity index fund is not meant for short-term parking money. It is considered better for goals where the time horizon is long, and there is the capacity to withstand volatility. If the money is needed in the next 6 months, a market drop can turn you into a forced seller. And an investor who sells out of compulsion often loses the benefit of compounding. Bogle's real lesson is bigger than the product. It makes investors honest about their behavior, costs, and time horizon. When you understand that costs are guaranteed and extra returns are uncertain, decision-making changes. Instead of flashy promises, you start looking at simple arithmetic. This very arithmetic can save the winner's game. Market ownership can be a winner's game, but high costs, high turnover, and emotional action turn it into a loser's game. This is the biggest lesson of part 3. Saving your return is more important than earning a return. Wealth is not built just from the market. Wealth is also built by stopping the leakage. The story stops here for now, but the next question goes even deeper. If costs are so dangerous, do professional managers truly beat the index in the long term? In the next part, we will see what the real picture of performance looks like behind the glamorous world of fund managers and why a past winner does not always become a future winner.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.